As
There
usual,
we
I
are.
won't watch that part.
But we thought we were on air. We started the show 2 minutes ago. You guys all missed it. We have to recap it. Also, I was tired today, so I've been pounding caffeine for like the last 45 minutes. So I make it through the show without having to sprint to the bathroom. It's going to be a minor miracle. Welcome back to the Trader's Edge podcast. I'm Jim Urio. As always, Bob Iacino, who is the technical strategist, chief investment officer, path trading, all that good stuff. Bobby, how are you?
I'm good. I apologize for wearing such a crappy shirt. Normally, I've got a nice T-shirt on, but
what's up with that?
It's like pull it out of the
barely
hamper.
Vendago.
Pull it out of the hamper. It wasn't wrinkled enough, so I thought I'd just throw it on.
And before you guys joined us, we were joking that Italian Americans are like the last culture you can actively make fun of, accuse them of being criminals, being violent, mostly because it's true, right?
Yeah, so my wife has a theory on this. She said that Italians don't get mad because they're just so full of themselves that anything you're saying they take as a compliment. No matter
that is right on, in my opinion. That's brilliant.
Right?
Oh my gosh, yes, yeah, I love that. Well, good. So today the stock market cratered again today.
Yeah.
Right. So reverse can't keep these bids. To me, it just seems like an adjustment to higher rates, which is something that was interesting, though, that I'd like to talk about a little bit, too, is that yesterday the stock market cracked and people bought the short end a little bit, implying like it was almost such a panic that perhaps it was going to influence Fed policy on the short end. Today, the stock market cracked because people were selling rate products, meaning rates going up. Right. Did you find that interesting? And what does it all mean?
Yeah, I did. So we started out the day with rates lower, except the 2-year, right? When you looked at it this morning, only the 2-year yield was higher. The rest were all lower. And I'm doing my work, looking around. All of a sudden, I'm like, holy crap, look at the 2-year now. As I speak, it's 514. It was 507 this morning. It was 502 yesterday. So the short end is definitely screaming, but we still got a 10-year that's now highest level since like 2006.
Right.
So the whole curve is moving, and well, we could talk about the flattening, steepening if we want.
No, I know. It's funny is that you mentioned the 2-year as being the short end, which is the way most people view it and consume it. I was thinking, in the SOFR curve, the Eurodollar curve, the much more attuned to what the Fed's going to do next week, not what the Fed's going to do in 6 months. What is the Fed going to do in November? They're not doing anything, are they?
No, I don't think they're doing anything in November. I think we're at the end. I already won my bet with you on that one extra
$1. Yes.
Which is basically a binary event at that point. It's not intelligence at all. It's just luck. But I don't think they're going to do anything more. But it's only because I see data softening, and we could talk about that.
Yeah. Well, some of the data, like the labor data, is you see the revisions that all 7 months have been revised lower. The June number, which came out at 210 when it originally came out, has been revised twice to 105. So at some point in time, you have to either call bullshit or say that the model is so clearly flawed and the birth-death model does not understand what happens in market pivots. Oh, the caffeine's starting to kick in. I'm starting to feel passionate already. It doesn't understand what happens in market turns, which the market is turning right now. Corruption or just a bad model, Bob?
So one of the things that you always talk about, and I actually mentioned this on an interview I had this morning. I had a TV interview this morning, and I said that my thesis this entire time. So I'm going to say something that sounds like I'm puffing up my chest and claiming that I was right, but I'm not, because it was luck. I've been right on the exact number of rate hikes over this particular cycle. Not necessarily the aggressive nature of those hikes, but the number of those hikes. And that is not intelligence. That is pure luck. And what I normally do, which is slightly different than what you did, is when the Fed says something, I default to believing them until they start to pivot. Then I try to react from that. Correct me if I'm wrong. When the Fed says something, you just think they're full of crap, they're stupid, they're lying.
Yes, but there's a big caveat. That yes, without question, that answer to your question is yes, but that doesn't matter, because what's important to my line of work is what the market is going to think of what the Fed said. So my axe to grind with the Fed to think that they're buffoons and don't know what they're doing, or they lie about what they're doing for a real live reason, doesn't matter. So we end up on the same side.
To add a compliment to that for you, because you say, okay, the Fed's lying, blah, blah, blah. And you're on the side of the market when you say that, because in this entire time, if people would have believed me when I said the Fed is going to aggressively hike rates, they would not have bought equities. And equities went up basically the entire time, right?
Right.
Anticipation of a recession. As we talked about before, at the beginning of recessions, stocks actually rally. And then the rally continues through the rate cut cycle that then comes in to try and slow the recession down. So by that token, I said to myself, okay, they've done every rate I thought they were going to do. Am I starting to see signs that they're going to pivot? And I think I am. And part of it was because the actual statement and dot plots were so hawkish. And then Powell just kind of like was timid in the actual press conference. So that to me was a weird sort of juxtaposition. So I thought something we could do today. We're talking about the data, right? So durable goods is a good example. We've got a durable goods chart. This, of course, is again from our friend Mike Singleton at Invictus Research, who I promise you guys we will have on the show. He's absolutely brilliant. And he's young. What is he, 18, 19?
Oh, God, he looks like he's 18. But
he's
seriously, though, he's one of the first things I read in the morning because he's very well spoken and he's got a really good grip on things. So thank you, Mike Singleton.
You saw this. This is durable goods volumes are well below trend. Now, he points out that dotted line in the middle that you're seeing on the screen right now, that is essentially the trend of durable goods volumes from January 2016 on, right? And you've got those two exaggerated, the pandemic and then the recovery from the pandemic with extra stimulus checks and so on. And then you've got the rate hike cycle where we started to go below and we are not above it. And today did not change that. That 0.3 number that we got, even though it was expected to be negative, ended up positive with today's durable goods number, has not changed this chart at all, right? Yeah. And then the other thing I wanted to point out before we go into what we plan to talk about, he talked this morning, again, Invictus Research, not my research. He started talking about micro caps, right? And he was talking about sort of the breadth of the market itself. And while the equities had been rallying and had held in, this is micro cap. So for those of you that don't know, most of you I believe do, micro cap stocks move the most in the bull markets and they fall the most in the bear markets. And throughout this year to date, we've only had 37% of the micro cap stocks higher on the year, 63% lower on the year. Go ahead, Jimmy.
Question to you is, do you believe the majority of that underperformance is based on the fact that so many of these companies have borrowing needs that are more important than bigger companies, right?
Yes, I do. And as a matter of fact, I've got a chart of that, and I didn't send it to the guys beforehand. If you want to blather for a minute, I can look it up. But basically, and we talked about this on our podcast, and you saw the chart there, Jimmy, when we talked about it on the podcast. I have essentially a funding needs chart, and I'm going to go ahead and just share this screen.
By the way, this is a monster issue. The reason that we're not in a full-blown recession right now is because so many people, companies, individuals had the ability to roll into duration in the 5-year period right up until the first rate hike, where 10-year yields were averaging 1.95, 1.96% for that 5-year period. If you had funding needs that you notice were going to last many years, and you didn't roll out into a 10-year, 30-year loan on the mortgage level, you were an idiot. But what happens then is that it took some of the punch out of my blathering good enough, by the way, too, because for me, it was like challenge accepted. But so the punch of this rate hike cycle is not to be felt until a much later date, because things have to happen. Companies aren't starting because their borrowing needs and the immediate term are much too high. So everybody could sit back and say, wow, it sucks to be you if you have to borrow at 8% right now, because I locked in at 3% before. So it just took away the immediacy of the efficacy. And also it also started giving people 5% on their savings as well. So it's punching money into the economy in other areas too. So that's one of the reasons we haven't seen the recession yet. And the fact we haven't seen the recession yet, it's just not reflecting at all in the bottom, in the top 20% of the people who have all that stimulus money from the $7 trillion that was injected in response to the COVID mitigation strategy. So that money was put in. The top 20% of the people are still driving everything. Luxury goods still doing fine. Travel still doing fine. 80% of the people are really starting to suck wind. What did I say that was wrong? Anything?
Absolutely nothing. And that's why I want to put up this screen right now. This is essentially a corporate sector external financing needs. And what you're looking at here on the line chart there, the line graph, is the share of companies with negative free cash flow. So free cash flow is used when you can't borrow, right? So when you can't borrow, and by the way, part of your free cash flow that's post paying your financing needs. So as the financing needs get redone, what's the word I'm looking for, Jimmy? Refinanced at higher rates, this particular number gets even worse. Okay, this free cash flow number. And so if you have negative free cash flow, which again, corporate sector, 38% right now has negative free cash flow. And as that external financing need grows at higher rates, that 38% is going to go higher and higher and higher. And that will cripple a lot of these companies, starting with the zombie companies. And we're actually starting to see bankruptcies increase. They're small numbers right now, but if you look at a bankruptcy chart, it's straight up.
Yeah. And by the way, this is everything is a double-edged sword. Bobby and I always talk about Thomas Sowell, and one of his quotes that we live by is, "There are no solutions; there are only trade-offs." Yep. I've argued for 10 years that the preponderance of zombie companies within the S&P 500 was way too high, and that the Fed was keeping them alive with cheap money, creating this bad environment where it could all collapse. Now all of a sudden rates are higher than the neutral rate, and a lot of these companies are going bankrupt. It's not that I wanted it to happen this way. I don't want the government swinging the pendulum both ways. The market should be determining these things now, and now they're doing they're opposite to the other side because we were ahead of the neutral rate. Agreed?
Yeah, and it kind of brings me to the UAW strike, right? So when I see God, I don't want to be called political for this statement, but when I see
policy,
it's policy, right? It's not a party. I don't care which party was doing it. Quite frankly, the Republican Party made a lot of promises about draining the swamp and bringing manufacturing back, and most of it ended up being rhetoric. Some of it worked, okay? And now you've got this administration saying things like American manufacturing is back, not giving credit to the actual start of that in the last administration. I wouldn't either. Right? You don't want to do that. You want to take credit yourself. It's politics. But you see a president on the picket lines, right, saying that they should get raises when a lot of what's happening in this UAW situation is because of the EV push. A great deal of it is because of the EV push. When you're looking at auto workers who, for example, the average Tesla employee, and this includes Ford employees, it includes a guy who pushes a broom and an engineer who divides.
So he means EV employees. But anyway, go on. Yeah.
Well, Tesla EV employees, the average employee, regardless of what the job is, makes $34,000 a year. The average UAW union worker makes somewhere in the range of $67,000 a year, and they're looking for an overall. They dropped down to 36% now increase, right? And they're saying we want to make our companies more competitive by giving these workers more. It doesn't work. It simply doesn't work that way. And I'm not saying that the corporations are not making huge profits and they should not share it with the laborers. I don't have a dog in that hunt. I don't work at an auto company.
I'm going to add something that I think you would say too if it was a Republican president who went and was with management and ownership pointing fingers at the striking workers and taking sides that way. Yeah. We'd say the same thing. The government is not supposed to take sides in this. They already have. They've bailed out the auto industry once. And I believe that both sides are negotiating with the belief that the federal government is not going to let them go out of business. So it changes the negotiations, and it's stupid. You mentioned the salaries, the legacy pensions. They're not just competing against American car makers. If they have a product that's fine, but all their expenses are way, way too high, everyone will keep buying Japanese. We still haven't had the Chinese car makers come into our market. When they do, if they can provide them cheaper, Americans will buy them cheaper. And guess what will happen? The big three will go out of business, except for the fact that the government will step in and probably not let them go out of business. And they'll limp along making an inferior product instead of redoing their business model to figure out how to make and how to compete on a global scale.
Absolutely. You've got policy that is pushing EVs, which from the latest I've read, 70% fewer workers, and the EV shops are not unionized. And they're pushing the companies to do this while at the same time telling these same companies, this administration specifically, that they need to share their profits with the workers and give the workers what they're demanding, almost assuring that the internal combustion engine will go out of business, at least that part. And then the EV part will be subsidized by the government, maybe partially owned by the government.
Conspiracy theory? Did you just hatch right here?
I just did. You just did. I got a tinfoil hat right next to me, and I will put that sucker on faster. I'll get hat burn. I'll put it on so quick.
Right. I was a conspiracy theorist, but now that most of them have come true, I don't even know what to call myself anymore. Let's trade some. What do you got? Yeah.
Let's pivot. I want to put up a chart real quick. Now I'm going to do almost the rest of the show is going to be charts, right?
I love charts, and you know I do.
So I'm going to put up a chart And the first one I want to put up is the S&P 500. Then I want to ask you if you remember our September 5th recording of our other podcast with Mike Arnold and what levels he talked about in the NASDAQ, for example. So I've got it written down. You don't have to remember it. But
Yeah.
Can you see this chart?
Not yet. I'm about to, though. Okay, perfect. I can see it.
All right. So this is the S&P 500, right? And this is a daily chart.
Right.
So what we're seeing here is pronounced weakness. And what you're seeing here in the red line is the 200. Now, I want to kind of stay away a little bit. We talk about fundamentals a lot, you and I, and we agree on most of it. Sometimes we don't agree on the scope or the reasons, but we generally agree on most of this. What do you see when you're looking at this?
Well, the thing that jumped out at me, and it jumped out at me at the time, is there's a red bar, daily bar, about 2 weeks ago where it was a higher high and a lower low, and it closed on the beat low. Bingo. Got it right there. Okay. So the next day I would look for some weakness. I got it. And I remember this happening too. But then all of a sudden it makes this big wick lower and closes just barely down in the day. That didn't deter me. At that point in time, I was a bear. I started putting on shorts, and I accelerated those shorts when the next bar took out that wick to the downside. So to me, and again, we trade a lot of the same technical stuff. I look more that this guy, the late Rob Smith in the Black Trading, does a lot of work with these, the bars and the momentum based on that movement away from the moving averages. That's what I looked for. That's why I've been mostly short both indexes going into this.
Okay, so then I want to switch this to a weekly, because I have been trading long, very small, in a very mild way. Okay. So one of the things that Mike Arnold talked to us about in our podcast, and we record with Mike on the first Tuesday of every month, and then we release that the following Monday, basically free everywhere. So you guys can go watch that if you choose to. And one of the things Mike was pointing out, and I remember at the time that you had technically correct double tops in both. And now I want to double check if he said it about here. And this is the way that I'll double check it. And I'll walk through this if you guys want me to. But basically, you measure out the difference between this high and this low. And if this second high here reaches either 75% or 125% of this high, then you have a technically correct double top. Okay.
Oh, stop for a sec. Yeah. The first top you are talking about is the one right from where?
So it's this top right here. It's the week of July 24th. So I measure. So, in order to have a double top, first of all, you have to have a move that it would be reversing, which we have right here, right? Okay. Then you have to have a top, a base, and a second top. Right. The highest of that second top needs to be within 25 basis points in either direction of this top. So the easiest way to do that is to reprogram your Fibonacci's as GANs. GAN levels go every 12.5%. So now every single one of these is marked here. Now this particular high of this week is 45.66, and the 75% retracement of this move is 45.63. So that means that this high went into that 25 basis points on either side of this high. Does that make sense?
Yeah, it makes perfect sense.
All right, so that makes it a technically correct double top. And by technically correct, I mean that it's high probability. Okay, there might be somebody else that defines it a different way, but based on our research, it is high probability.
So as soon as it turns lower, you're a seller?
No. As soon as I get a close below this base, I look for a good risk reward sale. Now, within that context, okay, so I got to wait for a Friday close. If this rallies back above this base right here, which is 43.50, if it doesn't close below here on Friday, it's not a triggered double top. This right now is a technically correct double top that has not triggered.
That base. Okay. Yes. I love that.
Yeah. If I get a Friday close below this, it has now triggered. Now I have to figure out my risk reward. So
give me that level again, because I love my Arnold stuff. I'm writing that down.
Yeah, this is a Friday close below 43.50.
43.50.
Continuous S&P chart. I know a lot of you guys look at SPY, but you can kind of draw out the same thing on SPY if you want to.
Right.
And the reason I put it ES is because this is how I would trade it. So it's the easiest way for me to show it to you guys.
So, by the way, so Bobby and I are futures guys from way back. I'm still a predominantly futures guy. I trade a ton of equities. When I'm talking, I am talking about futures. I don't recommend. I tell you what I'm doing. Technically, I cannot recommend any equity product because of my futures licensing. Bobby certainly can, and I can go along for the ride.
Yeah, I can do that. And one of the reasons that I'm not doing that here is because, again, to short the ETFs to me, it's not something I'm terribly comfortable with at this point. I got
Why?
What's that?
Why?
Because of the functionality of shorts for me has always been easier in the future, and that's what I came up with.
Because you don't have to borrow.
I'll go long. If I'm going with the indexes, I'm going with the futures. If I'm going with ETFs or individual stocks, like if I want to play a sector, I'm going to go with an ETF. And if I want to play an individual stock, obviously I'm going to individual stocks. It's not a point where like I think Nvidia is going to pop, so I buy the NASDAQ. I don't do that.
Yeah.
All right. So I just kind of play with the thing that, I how did they used to tell us to say that at CME, Jimmy? I express my opinion. That's
okay.
Express my opinion in the actual thing I'm looking at. So anyway, so if we had a close below this 43.50 in the S&P futures that on Friday's close, that will now be a triggered technically correct double top. So what does that mean? Well, then I would then delete this and I would use the exact same tool to figure out my two targets. Okay. The first target would be this 175 right here. So that would be 41.88. Okay. That would be my first one. Now, you also notice when you scroll to the left here that it hits some pretty significant support. I'm going to move this blue line to where that support is. Right around here, this rotation area on a weekly chart.
Right.
That's going to be significant support to me. And this line comes in almost exactly at it.
Perfect. Yeah.
All right. Then the second one would be this 200 extension. Okay. So it's a 175 extension and a 200 extension. The extension is now from this low to this high extended down. Okay. Now, the only way this becomes a two target trade for me. Now, one of the caveats for this on this 200 level, this is the move I'm reversing, and it does not include this rotation to me. It doesn't go all the way down to here. It starts here. If this 200, let's just play around with this for a second. If this 200 were lower than this area here, this would not be my target. This would be my full target.
Okay, because it's a little harder to push through the 200.
A little harder to push through this support. And then this also becomes support where a lot of people want to buy back again because you've got this area here and this area here. It just becomes troublesome. Okay.
Yeah.
So that's the way I would be looking at the S&P. Now, when we did this on that show, Mike Arnold was very keen to show us the NASDAQ 100 futures on the weekly chart, which is right here. And you notice you have the same pattern. You guys could trust me that this also measures out the same way. Unless you want me to should I show it?
No, it's within 25 25 percentage points either way. Yeah.
Yeah, give or take.
There's no doubt that it is.
Matter. Okay.
Is the high of the candle or the high of the wick?
The wick.
Okay.
You go from low to high or high to low in the case of a double bottom. All right. So this one has to have a close before below 14,609. Now you probably can't see this because I'm going to reduce screen right now. Can you see this little note thing here?
Yep. It says 14,609. Yeah.
I wrote that down September 5th. And for those of you who maybe think that I'm kind of doing this in arrears, you can go back and watch that podcast, which came out on, what would that have come out on?
By the way, the one thing that people have never questioned us on, because we're usually fully willing to admit when we were wrong, when we are right, go back, check the receipts. It's not worth it, though. We would not lie about it. We're not.
Yeah, we don't have any interest in doing that. What for?
Right.
So
yeah.
If I now measure this out, okay, these both fall within, there's no support in the way, nothing. So I might even bypass this 1376 and go down to 13.
Go to those highs.
And there's still a little bit more room to the downside, but I would still exit my short here. Now, you end up coming into this area here. Something that Cameron Dawson said this week, okay, is that she expects if these break down, I don't know what her levels were, but if they break down, she expects them to make a run for the 200, except the 200 week, except the NASDAQ, because it's too far of a move. Let's look at how far this move would be off of those highs if it were to happen.
Down to the 200-day moving average, right?
be about 21%.
Oy.
So we'd be in another bear market all of a sudden
Yeah.
off of those highs, right? And as I've said before, we never, in my view, we never really came out of the bear market because I don't look at it that way.
Now,
But
can I add two things?
please.
One thing that I speak for Bobby that he didn't mention, all those green candles on the stairway up, to him, that's like a clear space. There's little resistance when the fall begins to happen, right?
We used to call it space, and we changed it to a clear path when we changed the company name to Path Trading Partners because we're clever like that.
You're clever. That's really clever stuff. Yeah.
They call that something, a synonym or an anagram, or I don't know.
You should have hired a marketing company for that, which, by the way, to be clear, some of the marketing campaigns I see that I know they did hire big ad agencies for, yours is way more clever than theirs. But anyway.
I tried to get Dylan. Never mind. I'm not going to do that. So what this means is, and this actually comes from a concept on the trading floor, Jimmy. If you remember, when we were on the trading floor and you were trading, you didn't necessarily have a chart in front of you all the time. You're flipping phones. If you were one of those guys in the pit, you were running in and out of the pit. And you didn't always have a chart. So what you tended to remember were breakout prices, right? You'd say, I don't know what went on here, but I remember that my shorts got crushed when we got to about 1303. I just got killed on that move, right?
Yeah.
So they tend to remember these levels, right? Then they go, oh yeah, I bought up here and I had to get stopped out down at around 14.6 or 14.619 or whatever. The pit guys would remember these levels, okay? And they didn't really play in here other than covering shorts, right? Or trying to pile onto longs irrespective of price, right? So when the market gets back down to this area, if I draw on this, never mind, you can't see it if I draw on it. I know it already, so I'm not going to answer that. If the market gets down to here, it doesn't have any significant support on a weekly basis stopping it. Okay. Now it does on a daily. Okay. If we make this a daily again, kind of go back to that same area, which is essentially May, right? You do see kind of these little rotation areas. But as we all know, just from knowing basic data, the more valuable the conclusion is. Weekly charts give you more data than daily charts do. Daily charts give you more data than 4-hour charts do, all the way on down the line, because there's just more price action in a weekly bar than there is in a daily bar. Right.
So if you're a day trader, can I interject for 1 second here?
Sure.
So if you're day traders, if we get our settlement below 43.50 in the S&P at 14.609 in the NASDAQ, and come Monday, it'll be all right. That's the Jimmy Buffett song. But come Monday, the way I'll trade it is my bias for my day trading. And by the way, if you guys who've been following me for the last 10 years know that I always, up until a couple of years ago, I said, I am an okay day trader. I'm more of a swing couple week trader using options. That's where I make money. The day trading is to fight boredom, and I generally make a little bit of money, but that's it. I've gotten a little better at it too, because I figured out something I was doing wrong, which was not taking profits quick enough. You know what I mean? Just, like don't try to hit a home run. Don't try to hit a double off the wall. Sometimes you get a bunt single, it's just fine. But anyway, the way I would look at this then, if we get our settlements, I will go down to a 60-minute bar and look for setups for entry points to trade from the short side on day trading. You don't do a ton of like day-to-day swapping in and out, right?
So no. So my average hold time is 26 days.
Okay.
So that doesn't fall into the category of a day trader, but I have had trades for 3 hours, and I have had trades for 3 weeks, 3 months, 4 months. I'm still.
But you rarely have a trade that you intend to only have on for 2-3 hours.
So the funny part about it, Jimmy, I don't have any intention for time at all. It just works out that way. So I do exactly what you do, though. So I'm looking at this weekly chart, right? Or it's not a weekly that's up here anymore. So let's put that back.
Daily, right?
Illustrate this. I'm looking at this weekly chart. So if I get a weekly close, this is the NASDAQ. So if I get a weekly close below 14.609.25, that means Friday we fall, we close below this. Okay. I'm not just going to sell at the open on Monday. What I'm then going to do is drop down to a daily chart. Okay. Now, what do I see on a daily chart here? Well, I may have talked about this in here before, and I may not have, but I know you've heard me talk about this. What we have with these two moving averages, we call it a rotation zone. Okay. And what it is is an 8-period exponential moving average. And I say period because if it's on the daily chart, it's a daily period. If it's on a 4-hour, it's 8 4-hour periods, etc. So on. Continue at your own pace. Talk amongst yourselves. So this one is an 8 EMA and this one is a 21 EMA. This is the rotation zone. So what do I do when they cross? Nothing. I recognize that a rotation zone is forming. Okay. But if I now have a move like this where price is pulling away from the 8 and the rotation zone is widening and angling sharply, which is what's happening right here, right? The two moving averages are coming wider apart and they're in a sharp down sloping angle. Now, because I haven't figured out how to draw on this chart yet, I'm sure there's a way to do it. I'll ask the guys in the booth later how to do that. But if you look back here, okay, when we got this cross, I would have done nothing. However, when we got this 3-candle move into the rotation zone, I would then draw what I call a best fit trend line here, okay? And I would wait for a close below it, and that would be my short signal. Now, there's a lot more that goes into it. There has to be risk reward, et cetera. Well, there's a lot more that goes into it. So if I think I could draw with this, can't I? Let me see if I can figure out how to draw with this. Yeah, here's a highlighter. I'll just play with the highlighter. If you guys, hopefully you guys can see it. Can you see if I do that?
Yeah, I can see it.
All right. So
I had money in my head bet against you that it was going to work, but
yeah, I'm just terrible at this kind of stuff. Let's see, style. Can I make it less opaque? You guys are what? Forget it. I'll figure this out for next time. Yeah. If all of a sudden, let me delete this one. If all of a sudden we get a move like this, okay, and assume these are green candles, okay?
Yeah.
That's a really weird looking green candle. We can crack jokes about that later.
Okay.
So if I were to
I am already.
I would then draw a trend line like that, okay? And as long as we didn't break above this, rotate back down, and then start to head up, I'd be waiting for a close below this trend line on the, remember, this is the lower time frame, right? And then let's say I now have a red candle that does this and it closes. Why the hell is that happening? I can't have two of these. It goes like this and it closes below it. Okay. So I'm now short on that close.
Right. Okay.
And now I'm preparing my stop and my target back on the weekly chart. So I do essentially a version of what you do where I go to lower time frames to look for entries.
Right.
Right. Which is, I'm not wrong in saying that's basically the same thing you do, right?
Yeah. Oh yeah, no doubt about it. My slant is a little bit different. I look for, like I love a good encompassing bar and then the next bar below it. But I incorporate some of these things in it, mostly because over the last year and a half, I've learned them from you and my Colonel.
Well, that's nice to hear. I don't know how to race these, so we're stuck with these two for now.
Okay.
So let's take a look at some sectors. You good with that?
Of course.
If we got time, I'd like to look at sectors and then we could kind of come up with a thesis as to what might lead, right?
Right.
Because this to me is the time when fundamentals are not as useful as they normally are.
Right.
And just that's my honest opinion. So
sure, of course. Well, because can I take a spot to just address that real quick?
Yeah,
what's the fundamental argument? I mean, we know that the Fed could pivot at some point in time. We know that rates are relatively high right now, and on a substitution basis, your dollar, where you choose. By the way, I bought bonds yesterday. Like I've been trading bond futures my entire career, but the last 20 years, whatever, there's been just so little bang for your buck in actually buying a treasury bond through Treasury Direct that I've never even done it. Till yesterday, I did it. I bought 6 months, going to get my 5.5%. I thought it was fascinating. But anyway, I don't even know where I was going with that. Oh, the fundamental story. Fundamental story favors both sides. Price action is what's more important. Bobby and I always describe our trading style, and this was independent of each other, as let's call it 30% fundamental. We just do that to kind of fortify our beliefs and buttress our argument. But 70% of it is technical analysis. And price knows. Price wins. And it does. Is it perfect? It is far from perfect. Are there higher probabilities? Yes. That's what we try to do.
By the way, I love buttress. I've been trying to use exigent, but I
don't know what exigent means. Tell me, because I love a good word. But I use fortify and buttress in the same sentence, to be clear. I should get some star points for that.
It means it's critical, it's important, it needs to be done now.
Okay, what's the word again?
In the exigent. So in the movie Lincoln, they said, please tell your congressman you support the 13th Amendment as a military exigent. And I heard that, and I'm like, I need to use that word.
I'm going to use it too. Yeah. Because, by the way, so we talked about Italians at the beginning, because when Bobby and I grew up, Italians were always kind of where we came from. Italians were looked down upon,
Yep.
mostly because we were shorter than everybody. But they, we had 11 people living in one home, so we do like to act like we're smarter than everybody else on occasion, just to make up for deep-seated insecurities that were fueled when we were children. But anyway, please continue.
This is the only disclaimer for this show. We are not smarter than everybody. We're hardly even as smart as we pretend to be.
So, we are about 80% as smart as we pretend to be.
80%. So I want to look at the sectors in the context of what we just talked about, and I want to stick to the weekly charts. So this is technology. Now, technology led what people are calling this recent bull market, which I call a bear market correction, right?
Right.
And technology has the exact same, I would argue maybe even a weaker. There's a technology sector, it's the XLK, so it's a spider sector technology ETF. And this, I would argue, has a slightly weaker pattern than the NASDAQ itself does.
Now, why? I thought it was just the same. I thought it was the same.
No, the NASDAQ is not even printing below this low yet. It has printed below it. But if we go back to the NASDAQ chart, for example, and this is kind of the comparison I was hoping to make. Here's the level. So the NASDAQ barely printed below it. I wish I knew how to get rid of these now. I think there we go.
Oh, wait, is the difference then, because is that closing times and how long it's open, things like that? Is that why there's a difference in the chart? Or are they, because they're the same instrument, essentially, right?
Well, if in theory, this is the NASDAQ 100.
Okay. Oh,
right?
okay.
So this is not the composite. So, but the technology sector is missing certain things that are in the NASDAQ, right? Because it's pure technology.
So it's not the same.
The sector ETF manager, the companies that are in it, where the NASDAQ just has everything that applies to the NASDAQ.
Yeah, okay, that makes it complete sense. So they're highly correlated, but certainly not perfect.
Exactly. And they are very correlated. Again, looking at this technology sector fund. But the spider sector ETF is actually weaker than the NASDAQ right now. So if you're talking about the NASDAQ being the leader to the upside, and it stands to reason that they could also be the leader to the downside, technology, specifically the sector, it's starting to lead a little bit to the downside. That's my takeaway from this chart.
Okay.
Let's look at healthcare. Healthcare doesn't even have the same pattern. As a matter of fact, I would argue that healthcare is in a slight uptrend. If we just take like a really bad channel, okay? And by the way, this is the first time I'm looking at these. Yeah. So this is kind of on the fly. We could almost say that healthcare is in a weirdly shaped up channel just in this recent data here. I could probably compress this, and this is a weekly. Geez, I've been looking at healthcare and not deleting stuff.
By the way, when we say a sector, healthcare is somewhat defensive. It is oftentimes a dividend play, which doesn't look as good in a high rate environment. But the defensive part of it is there anything else to add to the fundamental key bullet points of healthcare? One
more thing: it's the second largest industry in the U.S. after technology. So. It's very, very important, and it's impossible to have a diversified portfolio without healthcare, in my opinion.
Right. Yeah.
So, but healthcare, while it is falling with the rest of the market, is in a much stronger medium-term pattern than technology or even the overall S&P 500. So,
So if the NASDAQ triggers, the XLK triggers, and the healthcare is still staying within that channel, would you be motivated to put a spread on?
I would. And that's a great question. And the reason that I say that is because healthcare is defensive. So you've got some money that goes into cash, going into treasuries, going to gold, whatever. And you have other money that has to be in equities. They go into defensive strategies. So there's a decent size spread to be put on there. The key to that spread to me, Jimmy, and tell me if you think I'm nuts, the exit. You have to be super careful about exiting that spread, because when things snap back, technology snaps like a frickin' bottle rocket.
No doubt about it. So I would be hedging it with options. And oftentimes, like in a normal day, like I have a lot of clients who are trading a lot of futures. So my trading is about half it. And sometimes if I put on something so complicated to exit, I sometimes get bit in the ass by not being involved with a huge option trade at this time these things are going. So if you guys are full-time traders, it's different. But if you're not,
And if we have a few minutes at the end, remind me to ask you something about that change you made from taking profits early, because I think that's interesting, and it's kind of, you almost predicted it with your words and actions. But anyway,
Yeah.
XLF. Okay. Very similar to
Financial.
healthcare. Although in the short term here, we've got a way worse sort of double top. I don't think this one, it doesn't visually look technically correct to me. Let me just go ahead and measure it real quick and see if what's the wrong way. Hold on. I want to see, and if it's, by the way, if it's not technically correct as the way myself and Mike Arnold measure it, that means it has a very low probability of, it's got about a 50-50 probability as opposed to a mid 60s to high 60s probability. So you can see this high does not get as high as the 75. So this is what we call
that's the 75. Okay, got it.
Yeah, 75 is right here. It's very hard to see, but here it is right there. And this high does not reach that line. So it is not a technically correct double top, and therefore it's got a much lower probability of reaching its targets. So Mike and I in conversations would always call it a sloppy double top, meaning that it's not something we would trade. Okay.
Makes sense.
All right. So let's go to the next one, which is real estate. Look how bad real estate looks. And again, we're on a weekly chart. There's no pattern here for me to trade unless you're somebody who wants to trade sideways channels, which you've got right here. I have a way of trading sideways channels, but it involves a lot more price action than we see here. So to me, real estate is just, it's dead to me. Again, to be stereotypical Italian, this thing is dead to me. I got no interest in this sector, certainly not going to go long it. And to go short it right here, a snapback could really hurt you if the Fed were to begin cutting rates. And this is the iShares, which has a heavy dose of commercial real estate in it.
I was about to ask you that. Good.
Yeah,
okay.
It's got a heavy dose of commercial real estate. Not only that, Jimmy, but there's a couple of hedge funds that are actually fighting in Chicago about commercial real estate. There's one hedge fund, I actually have a friend that does some business with them, that just bought, it's the first purchase of an office building in Chicago, 27-story office building. They bought it at a 60% discount from its last sale in 2017, and they bought it. And they plan on updating it and filling it. And there's another hedge fund that is shorting Chicago office real estate. So obviously I'm talking about a specific territory there.
Market, right? Yeah.
Yeah. So I got nothing there.
Energy. Yeah, that looks like death to me. Yeah.
All right. Energy has actually done the rotation zone thing on a weekly basis. Okay. So the thing that I just illustrated with those oddly shaped vegetable bars that I was drawing on there, one looked oddly like a cucumber. So putting this trend line in place here. Now, the reason I call it a best fit trend line is I don't really care how it's drawn. Okay. I've got very specific rules for the way I draw a trend line. This is not it. Okay. I like to draw it against the bodies rather than the wicks when the wicks are not exaggerated, right? When they're exaggerated like this, I get a little more nervous about the wicks. But when they're just normal kind of run of the mill wicks, like you might have seen in the last bunch of price action, right?
Yeah. Can I add to that real quick?
Please.
One of the things, just from being in for 35 to 6 years, the long wick means a very strong price rejection. So that to me means something. We're not sure what it means, but it means something serious. But anyway, go on. Yeah.
And actually, Jimmy, you know that I got long crude oil futures. This is the ETF. Yeah. But you know I got long crude oil futures August 31st, right?
Yep.
Here's the week. Here's that week.
Right.
So here you got this move down to the rotation zone. You've got a downward channel some downward price action developing going into the rotation zone. I draw the best fit on a lower time frame. I get long and I ride it out. So my target, I don't want to talk about my futures, but it doesn't matter. Talking about sector situation, I see a potential opportunity here in energy. Now, Goldman Sachs calling for 107 crude oil. Carly Garner, who we both love and respect, and she'll be on the show as well at some point, calling for $100 easy. I'm not on the same page with them, but if they're right, this is your trade.
Mm-hmm. Tell me, the XLE, when you say energy, is it primarily oil? What percentage? It's not natural gas at all, right?
There's natural gas as well, but it's very high oil services, oil drillers. It's very oil related.
Okay.
All right.
By the way, if it takes out that trend line with a little gusto, it also takes out those highs from back a couple months back, bingo, couple months back, bingo. So at the same time, it's got to take out that trend line aggressively, but it could clear the path. And as most of you guys know, again, You can go back and check the receipts if you want. I know none of the people who follow me all the time will, but I've been big, oil up for a long,
Yes,
long
you have.
time. And I believed, for me, it's maybe part of it is because of my sinister belief in government doing everything stupid. And I believed that the Saudis and the Russians were going to put the screws to us for selling out the SPR when they didn't want us to. And that's come to somewhat fruition. I'm not sure if that's reflected in the price. Maybe I just got lucky. Maybe my hatred and cynicism fueled a winning trade, but it's worked out pretty well so far.
Yeah, and it also there's a place in here where I can draw shapes, and I kind of don't know where it is. But anyway, I'll figure all this out as we go along. This area right here. So I don't trade triple tops because I've looked at about 25 years of data, and so has Mike Arnold. And Mike Arnold has told me that the data he's found, the triple tops are still mostly a reversal pattern, but when they break out, they extend and they generally don't fail. So if we get a break above these levels that you just pointed out, it's likely that it's a fairly strong and longer lasting trend to the upside.
Right. That's what I meant. Right.
All right. So here we've got materials, spider sector ETF. So commodities are in here, right? We've got miners, refining, chemical, forestry, companies like that. I feel similar about this sector, Jim, as I do about real estate from the chart. But I want to ask you your overall commodity view in the sort of time frame we're talking about here relative to that NASDAQ chart and that technology chart. I know the longer term path for commodities, especially metals, especially copper, is likely higher. I mean, that's my view on it anyway. I don't know it, but I think it's likely higher. What's your view here in terms of materials and how they relate to commodities?
My view is pretty simple. The market believes higher for longer in rates. The market believes soft landing will allow for that. If that's going to be the case, I think many of the commodities might have a difficult time unless they can convince themselves that higher for longer is because of this robust economic condition that's underlying. I don't believe that. I think the higher rates are juxtaposed against an economic condition that's deteriorating. So for the most part, in the shorter term, until the Fed looks me in the eye and says, yeah, that this tightening thing that's a story for yesterday. Now there's burning timbers falling from the ceiling and we're going to be easing. Until that time, I don't love them. I like, as we've said before, the fundamental story of copper, and that's why Bobby mentioned it, because I've been beating this drum a long time. The fundamental story of copper favors it as a 10-year play, in my opinion. The fundamental story of gold favors it a 10-year play. That's not what we're talking about today.
And if you want to go see Jimmy talk about this New Orleans Investment Conference, you could follow him on Twitter and he'll put information up there.
November
so something
2nd,
I wanted to point out on
speech.
this, something I wanted to point out on this materials chart that I noticed when I was looking at these, and I haven't done analysis of these prior to this, but I did notice that because commodities themselves, and by default materials, right, are a thing you can hold, they don't spend a lot of time below their 200-day moving average. And this again is a weekly chart, unless there's some sort of crisis. So here you have the pandemic, right? That's a decent amount of time below the 200. Here you have, relatively speaking, a blip. 2016, as a struggle a little bit. We had the Fed. Didn't the Fed hike rates back here? I don't know. Doesn't matter. But the big ones are here. Here's 2008, right? Great financial crisis. Here's the bubble, the 1999-2000 tech bubble, right? Commodities are a thing that you can hold, you can build with, you can actually use. If you get the 200 below here and it's sustained, something bad is going on. If you get the price action of the materials area. Now, materials underperform in really good times because, again, they're another defensive sector, right? But if you get them below the 200, it might be time to put some of your longer term holdings into these ETFs, shut the book for about 10 years and come back and look at how you did.
Interesting.
Yeah. All right.
Love it.
Running low on time, so I want to run through the rest of these fairly quickly. But this is consumer discretionary, as you might guess with consumer discretionary. Same path as the NASDAQ and the S&P 500, same double. This one is already reaching its 200. It's already made a weekly close below this base. Actually, let me confirm that. This low is 160.93. This closing is 160.93. So it did not trigger.
It did not. Wow, look at that.
Yeah. Okay. That's how important these levels end up being. Some people say they're self-fulfilling, and I say, so what? If I take a pill that was made up of sugar and water and it's cures my dementia, I'll take the pill all day. Right.
Yeah, might
So
not work for you, but yeah.
my dementia is pretty advanced. So this is consumer discretionary. Okay. Now let's move on to, by the way, that has a very high probability of triggering on Friday. So now we've got industrials. Industrials, similar, right? But this is construction, machinery, fabrication, manufacturing, defense stocks. This is one of those sloppy doubles. It's not technically correct, but it has already collapsed and it's
Already
likely
collapsed.
to
Right?
run for this area here, this support area. This has already collapsed through. This again is sloppy, so I don't even look to trade it. But we've already closed below it twice, so it's likely to make a run back up here, but then it's likely to fail again. So industrials can be somewhat defensive. Utilities, yeah, I want to run through these because I don't really care about these too much. But utilities also is terrible, like the real estate stocks.
Question.
Yeah.
Is that what I'm seeing? Utilities, that chart looks like death, much like the real estate. Is that just a function of the fact that people tend to buy utilities for dividend, and there's no reason to buy utilities for dividend right now because you can buy a treasury for 5.5? Got it. Yeah.
You took the words right out of my stupid mouth.
Well, I can't let you take all the credit this time. That's not my style
your
either.
mouth is just as stupid as mine, so I'm fine with it. This is consumer staples. Crap, about to close below the 200. That means it's going to make a run for these lows. High probability of it. When I say that, I don't mean it's guaranteed, but it's going to make a high probability for these lows here on consumer staples. By the way, a decent amount of this might have you starting to hear about store closures. Okay, Rite Aid filed for bankruptcy. There is talk that I cannot confirm about another large drug maker that could potentially that is having problems with shrinkage, which we all know is not Jimmy going into the pool. It's more a
which happens also. Particularly, I take ice baths now. I've told you about the ice baths, but we're talking about a different sort. Yeah,
it's theft. And we did have talk today of Target closing 6 stores in major metropolitan areas, including Chicago, Boston, Philadelphia, based entirely on shrinkage.
It wasn't unrelated to what you're saying at all about rumors of anything. Didn't CVS say they were closing a bunch of stores based on that as well?
Yeah, they did.
Yeah.
I'm going to leave it at that. So the last one is communications, and we'll be coming down to right about where I can comment on your trading. Communications ends up being partially tech, right? Because it's you get a new iPhone 15, you get bumps in Verizon and T-Mobile and things like that, right? Same thing when you get new phones or other goes. So telecom, you're talking about cable companies, internet providers, wireless providers, satellite companies, et cetera. Same pattern. And honestly, Jim, this is the best formed one of all of them.
I was about to say thing. I look at that and I don't know why, but that to me seems to have the best chance if it fits all our criteria to be a good short.
Isn't it?
Yeah, so it is pretty.
Yeah, what you're going to want to be looking for is a weekly close below this level, which I'll run the thing here. It's 64.32. We're currently trading 65.22. Okay. You want to look for a weekly close below there. And if so, I don't even have to measure on this one. Your target, you don't even have to worry so much about the 175 target, because if you look to the left, it's smooth sailing to the 200.
That's the part I liked, right?
Yeah, you're looking at 60.12, which may not be a big move in price, but when you look at that on a percentage basis from here to there, I'm just going to guess here. Well, actually, I'll put it in here. Coordinates. Let's go down to 60.12. Just to be exact on it, if it got to the target, you'd have a 6.5% winner with a very high probability of actually winning.
Right.
So,
by the way, that's if you have that probability, it's worth to put a couple chips on the table, in my opinion.
It really is.
So again, I don't tell you guys what to do. I don't know the depth of your pockets or your risk tolerance, but I can tell you what I may do. So
I'm done with the charts. I think people want to get a good look at me because I'm a very handsome guy when I wear a collared shirt. So
you're extremely handsome.
Here's what I wanted to ask you about.
Go.
So what I wanted to ask you about, you said you had problems not taking profits.
Right.
Since I've known you and you've confided in me that you would put on a trade, or we've talked about them on different shows, you have always thrown out the caveat that I won't hold this to expiration. I'll probably get out once I got a little bit of profit in that. Are you saying that you actually started doing exactly what you planned more? Is that
yes, but I had always done that on my trades that had like a week, 2 week option duration or longer. I'd always done that fine. Like, remember, we had talked about the 1x3s I had on for this down move that worked. But the whole time every day we were up 40, every day we were down 40, I'd alter a trade around it. So it turned out to be a very good trade. One thing that happened on it, which was interesting, is that I swapped out to get more duration on the puts I was long and have shorter duration on the puts I was short to take advantage of the theta. But then as they were getting toward expiration, the gamma on those was biting into my profits. So I rolled them out too. But today, like I made a couple grand on that position. So then I sold puts further on down to take some of that money out, like below all the ones I'm long. So now I'm like, for every 8 puts I'm short here, I'm long a further duration. Like it's almost a 1x4 now. Cause like I said, I've been monkeying with it. I'm long a further duration, 32 puts, but then I sold like 5-6 puts below it at the same duration as the middle one. But anyway, I can't, like I used to have my futures account, and in some ways in my mind, it was a hedge for the big one. No, I have to have a trading account where I want to extract money from the account, from trading, from the market today. I don't have to have on a hedge that I'm short $2 million worth of stock if we break 20% today. Cause that's what I'll just adjust my investment portfolio for, to have the right percentage of stocks. I do that on a bi-yearly basis. So once I started changing my mentality of it, and the day trading part of it is that if I have a couple ticks in it, why should I keep it on? Why should I take it off? Evaluate that the whole time. Not like, well, there's a level down there that I'd hope it gets to if it breaks through here. No, it hasn't broke through there yet. So you take the trade off. So don't be a hero. Get a couple bunt singles, steal a base. Then every once in a while, let the home run come to you. Does that make any sense?
Yeah, it makes a lot of sense. And that's why I asked, because again, you had always predicted that, you know what, I'm not going to hold this too long. I'm just going to take a couple bucks out of it, blah, blah, blah. And tip for anybody out there, one of the easiest ways to be consistent about what you do is to work in percentages, not in dollars. Because one of the things you do when you're trading small is, Jimmy's just said he made a couple grand on that trade, right? You say, I'd like to make a couple grand too. But that couple grand for Jimmy, and I'm making this up, I don't know this, okay? But that couple grand for Jimmy could have been 1%, could have been 0.5%, right? Could have been 1.5%. Whereas that 1-2 grand for some of the smaller accounts we're speaking to right now, it could be 50%, and that's too much risk.
That's dumb. That's too much risk.
Yeah. So when you're looking at trades, if you trade in percentages, then when your account gets bigger, which it will if you listen to us, that's not a guarantee. Past performance, not indicative.
It's not indicative.
Yeah, you literally, it's just a matter of adding zeros, and your actual activity doesn't change at all because you work in percentages.
Right. All right, let's close it out.
Yeah, we're done.
Yeah.
I predict the most amount of death threats on this show over all the other shows on the Tradier Hub.
Yep, probably. We have were they here for the weapons part of it? We jokingly said Italians usually have weapons, and without even coordinating, Bobby pulled out his bat and I pulled out my baton.
We usually have them close by.
Right.
Why do they stereotype us?
I don't know, man. I'm going to go make some pasta. Yeah.
See
you guys. Thank you, guys.